My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people want to make friends, just trying to make you some money. My job is not just to entertain, but to educate, teach, put it in perspective. Call me, 1-800-743-CNBC. Tweet me, @JimCramer. You never want to see a high-profile tech name get nearly cut in half because it can take a lot of other stocks with it through bowling-like pin action. Even as its problems might be company-specific. Unfortunately, that's exactly what happened today, with the Dow declining 60 points, S&P losing 0.84%, NASDAQ nosediving 1.92%, in large part because of a company called DocuSign reporting such a horrendous quarter. Why did one quarter matter so much? Do we really believe that DocuSign, the software company that makes it possible to digitally seal the deal on contracts, one that you and I use all the time perhaps, would be able to maintain the same level of success we saw at the height of the pandemic? Well, that turned out to be a pipe dream. Oh, yes, the quarter was poorly executed by management's own admission. And worse, there was a serious slowdown in business that management didn't see coming. But DocuSign was really important because so many investors were hiding in this one, just in case the Omicron variant or the winter weather sends us back into social distancing mode. Unfortunately, the company did a lot less business than anyone expected, even 90 days ago. Does that mean people are going back to signing contracts in person so DocuSign isn't being used as much? That's bad for DocuSign alone. Or does it mean that there simply isn't as much business being done in the part of the economy where DocuSign is popular, like financial services, real estate, healthcare? That's bad for each of those industries, not to mention all the tech companies that make their money by helping those industries to digitize. Throw in worries about Omicron variant and a weak employment report this morning that was kind of stunning, and you can understand why the NASDAQ could get obliterated. Oh, and by the way, it didn't help that Cathie Wood, darling stock DocuSign, yes, it's always been associated with her, took a major hit, sparking fears from traders that her whole portfolio was under assault. It probably is, but because she doesn't run a hedge fund, they can't really shoot against her. But her flagship ARK Innovation ETF, ARKK, was down more than 5% today. That raises eyebrows. I get why people are scared, but let me tell you how I see this. Going into today, DocuSign was trading at roughly 130 times earnings, at least not sales, for heaven's sake. Its collapse creates a puzzling environment where all sorts of skittish investors become desperate to figure out what tech stocks are really worth. What should they be selling for? And then there's the ETF factor. Because tech's riddled with these ETFs, a huge decline in a single stock like DocuSign can reverberate, drag down the whole group. In other words, today tech was guilt until proven innocent, right? Guilty, and nobody was proven innocent. While the Dow and the S&P managed to rebound near the close, the NASDAQ stayed down in the dumps. And if you have some of those in your portfolio, you're going to see that you lost money today. Remember, it's not a loss unless you take it, but it does feel bad. So then we have to ask ourselves, okay, well, this can't last forever. What could turn tech around? Well, that's up to next week. I think it's going to have to take individual numbers that are much better than DocuSign. So let's go to the game plan. On Monday, we have two DocuSign analogs. That's we've got MongoDB. And by the way, you may think the name's crazy, but it's a $30 billion company, $30 billion database software platform. And Coupa Software, we've had them on a bunch of time, a star in the field of cloud-based procurement software. Now, both of these companies have been big winners not that long ago, but they've been getting whacked for ages. And they got crushed again today. Coupa hitting its low for the year, down nearly 4% for the session. Even as the business really is very strong. Maybe something is wrong. Maybe we'll find out. MongoDB got hit even harder. It's down 6.5%. Now, this kind of action this late in the year is money managers dumping risky stocks and running for safety to the likes of, believe it or not, yes, American Electric Power. That's my favorite utility. MongoDB and Coupa also find themselves in the unenviable position of having to report right after what will no doubt be one of the very biggest weekends of when we're going to hear about the Omicron variant. I'd be shocked if that coverage is anything but entirely negative. Going to be tough. But then again, these stocks have been hammered already, so we have to see how they'll behave. Maybe the bad news is in them. Maybe there is no bad news. Tuesday night, we hear from SentinelOne. Here's a company from the hard-hit cybersecurity space. I was shocked to see that this stock had already come down from 76 to 46 for no obvious reason, aside from the broader stock market rotation. SentinelOne might be a good test case to see if tech's finally gotten oversold and can bounce or even go up. That said, you know what? I'm going to be more focused on Toll Brothers, the high-end home builder that keeps putting up amazing numbers. Mortgage rates are very low. Going lower still, I kind of tell you, you can maybe get a 2.5 for a conforming one. Profit margins have been good despite supply shortages. And thanks to the hybrid work environment, the stock's been a horse. Will Toll Brothers be hurt by today's weaker-than-expected jobs report? I doubt it. Bad employment data, what does that mean? It's going to cause the Federal Reserve to go easy on us as they wean themselves off aggressive bond purchases and toward rate hikes. As tech gets purged, funny managers have decided to see if Stitch Fix should get a stay of execution because, in a lot of ways, it's more of an apparel play than a tech play. I've always liked this one, but its stock has been obliterated. Get this. It's fallen from 113 in its short squeeze-induced peak down to 23 today. Again, we're looking for anything that might indicate when the digitization stocks are ready to bottom. Stitch Fix might give us a signal. Oh, how about this one? Wednesday's tech test case is a company called UiPath. And UiPath, this uses software to automate repetitive tasks currently done by humans, the stuff that you hate to do over and over again. Again, this stock's been cut in half, no fault of its own. Think the world's coming to an end? All right, then I got something for you, Andy Warhol. Campbell's Soup. This should be more of a judgment on the slowdown stocks than a judgment on management. Although unsteady soup sales and out-of-control raw costs could play a role. They did before. I hope they don't this time. Also, on Wednesday, we hear from one of our faves, RH. That's the retailer formerly known as Restoration Hardware. Now, this is another stock that's been knocked around. I think CEO Gary Friedman has a long-term view. The stock's sell-off in almost every single case has been a reason to buy, not sell. Oh, okay, then we got that second part of the market. We got GameStop reporting. That's the king of the meme stocks. Now that AMC's getting slugged by Omicron worries and insider selling. We still haven't heard a real turnaround plan from this new GameStop management, but the company might be getting bailed out by console shortages. I can't justify owning it up here, and I think the Wall Street Bets cohort has run out of firepower of late, except for to attack me in my mentions column, and I got bad news for them. I've taken the week off other than post dog pictures. See my... Wall Street Bets, you got to check out these pictures I just did of my dogs. They're hilarious. But anyway, there's tremendous prurient interest here in the rise and fall, perhaps putative fall, of GameStop. Thursday, we have some Cramer faves that I think will be able to handle the pressure. In particular, we get results from a pair of charitable trust names, Broadcom and Costco. Now, I discussed with Jeff Marks, portfolio manager, about whether to sell Broadcom today because it's up a lot. We got a big profit, but it's a technology company, often thought of as a chip maker, that's been remarkably consistent in an inconsistent world and also pays a good dividend. Very rare for a tech company. As for Costco, it's occasionally seen its stock get hit after big runs. I think you got a treat that is a buying opportunity. I'll give you much more on that later, so stick around. You want tried and true? How about Hormel? I mean, Hormel, now we're talking about, yes, Spam with a 2.4% yield. This is the limited edition pumpkin spice, which I've got to tell you is a little out of season right now, but as good as ever, and will be as good as ever 24 years ago, just like it was 24 years from now, just like it was 24 years ago. It's a time traveler. And it's the stock that's down big from its highs. Even as management just made some terrific moves with the portfolio. Or, you know what? Actually, not that much like Spam, Lululemon. They report, and I think that's going to give you a fantastic set of numbers. Now, I also want to hear from Chewy, too. That's the online pet food retailer that's seen its stock get cut in half. I posted some Chewy toys recently. You get the pattern here? It's called a bear market, people. Anything digitized is getting pulverized, all right? Digitized, pulverized. Friday, we hear from a consistent healthcare name that I think could be a very good fit for this market, and that's Centene. Yes, Michael Neidorff. The company's holding its analyst meeting where you're going to hear a lot about bountiful cash flow and buybacks as opposed to some of the things you're going to be hearing from some of these earlier ones. I like it very much. In the end, the strength in big cap stocks has masked the weakness in smaller players for some time. This was the week where worlds collided. I love that book. Will the beating continue next week, or has everything come down enough for that Santa Claus rally that I talked to you about earlier this week to start early? Maybe earlier than expected. The bottom line, I think we may be in for more punishment because the valuations got so out of control. But given the crushing blows we've seen so far, there's reason to believe that we're getting closer and closer to the light at the end of the tunnel. And no, it's not an oncoming train. Let's go to Paul in Tennessee. Paul.
Hello, Mr. Kramer. Thanks
Paul,
for
how are
taking
you?
my question.
What's up?
I'm well, thank you. I was wondering what your thoughts are on a retail stock. It's up over 400% this year, but it dropped almost 20% on Tuesday and another 8% today. Its PE is below 10. What's your opinion of Dillard's? ticker symbol DDS.
You know, Dillard's has had a very big move. There are a lot of other stocks that I prefer more than Dillard's. I would even tell you I prefer Macy's and Kohl's definitely more than Dillard's. And I'm not just calling it Dillard's. My mom always called it Dullards, by the way. Mom was kind of funny. Let's go to Lisa in Missouri, please. Lisa.
Cramer, Investment Club members, thank you very much.
Yes. Yes, thank you for signing up. Good talk coming up. Well, how can I help?
On November the 11th, you had the CEO of Lockheed Martin on Mad Money discussing the partnership with NVIDIA using Lockheed's AI technology to fight fires. And today they discussed defense technology on CNBC. Is it time to buy? The stock is down 16% from its high and yielding 3.36.
I like Lockheed. I thought the interview with Brennan Morgan, that was a really good piece. I don't know if you guys heard Morgan Brennan talk about Jim Tanklet today. She did a terrific job, and Tanklet told a great story. But remember, it's not really about the NVIDIA part. It's about much of the things that they do with the Defense Department. And Morgan pointed that out. But I like Lockheed very much. I thought the Northrop interview was good, too. I don't know if you guys caught that. All right, I think we could be in some pain next week. But given the crushing blows we've seen, I have reason to believe that the Santa Claus rally could kick in sooner rather than later. You don't get days like this too often. On Mad Money tonight, Boot Barn continues to walk all over the competition. It's up over 150% this year. And I'm getting the latest on the Western wear retailer with the company's top brass. Then this week's volatility was an important reminder to make sure your holdings are diversified enough and you don't just own every single tech stock in the book, which is why I'm playing Am I Diversified? See if your portfolio can pass the test. And speaking of tests, you've stumped me a couple of times on a couple of stocks. So I'm turning in my homework on 2 stocks, one of which I actually think you might want to pull the trigger on. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.